In the last 48 hours, the market quietly printed a number that doesn't fit the story most people are telling themselves. The S&P 500 didn't just wobble. 88. That is the kind of mismatch that shows up right before the market chooses a direction, not right after it's already chosen. Because when volatility is priced like a calm afternoon and price behaves like a storm, something is off. It means either the options market is underestimating what's coming, or the cash market is exaggerating what just happened. Historically, those two realities don't remain divorced for long. One of them has to bend. And here's the part that changes how you look at every buy the dip headline. The crowd treats the dip like an opportunity. Institutions treat the dip like a test. That's why, in moments like this, the entire next move can hinge on one number, one level, one band of price where the market either proves it's still in control or reveals that the control was an illusion. Right now, that band has a name on professional desks, even if it doesn't have a name on social media, the late January support zone. And inside it sits a reference point that keeps appearing in chart models, risk reports, and trader notes because it's measurable, recent, and brutally simple. 95. If the market holds above that area, the dip narrative stays alive. If it slips through it and can't reclaim it, the story flips fast. Not months later, not weeks later. Often in days, sometimes in hours. They said markets are more resilient now. They said liquidity is deeper. And yet the tape is already showing stress signals that don't match the comfort. This is not a conspiracy. It's not a prediction. It's a pattern. And the pattern is built from numbers that can be checked, repeated, and compared across decades. Welcome to Channel Name, where we decode what matters before it becomes the talking point everyone repeats. Here we focus on the data, the positioning, and the specific levels institutions respect. If you like analysis that sounds more like a calm briefing than a hype reel, consider subscribing the way you'd keep listening to a wise elder who's seen a few cycles. And drop a comment with where you're watching from, because markets may be global, but the perspective is always local. Now let's reconstruct what just happened, because the surface level summary doesn't capture the abnormality. Day one, after a day that was anything but smooth. Reports described sharp moves in mega cap names and sudden air pockets that made the index feel heavier than the closing number suggests. Microsoft, as one example from that day's reporting, was down about 10% in the session, and when a company of that size moves like that, it's not a normal day. It's the kind of day where liquidity becomes selective. What's important is not the drama of a single stock. It's what the market did around key levels during that volatility. In healthy pullbacks, bids appear in predictable places, and the market behaves like a staircase. Down, pause, stabilize, then either continue or rebound. In stressed pullbacks, the market behaves like a trapdoor. Down, rebound, down again, rebound, then a sudden slide that feels like the floor vanished. The central mystery is right there in the numbers, 88. If the market truly believed this was a routine dip, you wouldn't see the kind of intraday whiplash that forces risk systems to reprice. The two are telling opposite stories, and that contradiction is the signal. To resolve it, you have to stop thinking like a headline writer and start thinking like a risk manager. A risk manager does not care how convincing the narrative sounds. A risk manager cares about thresholds, levels where models change behavior, where mandates trigger, where the plumbing of the market shifts from cushioning moves to amplifying them. That's where the one-level idea matters. In modern markets, a large portion of flows are mechanical. Trend-following systems, volatility-targeting funds, risk parity allocations, dealer hedging, and systematic rebalancing programs can all shift from provide liquidity to remove liquidity when a level breaks. When people say buy the dip, they're usually describing a behavior that worked in the last phase of the cycle. But that behavior only works as long as the market structure remains intact. The moment structure breaks, the dip can become a trap, because the flows that used to cushion declines become the flows that accelerate them. This is the hidden pattern, and it has shown up in different costumes for decades. In October 1987, confidence had been building, and the idea that liquidity would always be there was spreading. Then the selling began to feed on itself, 6% in a single day. The public story focused on panic. The structural story was that rules-based selling met a market that could not absorb it fast enough, so the decline became a discontinuity. In September 1998, stress arrived through leverage and funding. Long-term capital management was not a household name, but its positions touched multiple markets. When spreads moved against it, the problem wasn't only losses. It was forced unwinds under time pressure, $6 billion to prevent LTCM's imminent collapse. And the arrangement was facilitated by the Federal Reserve, even though the Fed did not lend its own funds. That detail matters, because it shows how quickly private markets can freeze when trust wobbles, and how rapidly institutions will coordinate when the alternative is an uncontrolled unwind. In February 2018, the story was a quiet market and a sudden volatility shock. 30, a sharp jump that reminded investors how quickly volatility can return after long, calm stretches. The cause was different, but the lesson was the same. When positioning is built on low volatility, the system can reprice violently. In March 2020, the catalyst was external, but the mechanics were internal. Fortis on March 23, 2020, after weeks of moves that compressed months of volatility into days. Around that same period, the VIX pushed into territory above 80, reflecting how quickly risk pricing can re-rate when markets realize the regime has changed. Different cause, same fingerprint. Once key thresholds break, selling is no longer discretionary. It becomes mandated by models, collateral rules, and risk limits. In that environment, the market isn't negotiating with investors. It's negotiating with risk engines, and risk engines don't negotiate. They execute. The point is not that today is identical to those years. The point is that the moment of choice is always marked by the same tension, calm pricing of risk, colliding with violent behavior of price, combined with positioning that leaves little room for error. And that brings us to institutional movement happening beneath the surface. Start with a statistic that rarely makes it into everyday conversations: the cash level of professional managers. 3%. Cash is not just waiting power. Cash is the shock absorber of the system. When cash is higher, managers have optionality. They can add risk without immediately selling something else. When cash is low, even a simple buy often requires a sell somewhere else, which reduces the market's ability to absorb shocks smoothly. 3% cash level signals commitment, not caution. It tells you that many professionals are already deployed. That doesn't mean they're wrong. It means the system has less slack in the rope if the market stumbles, because the reflex response becomes reallocation, not fresh buying. Now layer that on top of policy. 75%. A pause can feel like stability, and stability can invite risk-taking. But pauses are also when markets become hypersensitive to the next surprise, because when policy isn't moving, expectations become the battlefield. A single inflation print, a single growth revision, or a single earnings cluster can shift the story fast. Then consider sentiment, because sentiment tells you how crowded a belief has become. 7%, we're bearish. That's not hysteria, but it is optimism. And optimism becomes fragile near structural levels because once support fails, optimism doesn't gradually fade. It often flips, and the flip is what creates urgency. Now look at the plumbing. The dealer ecosystem and the way hedges behave when the market approaches crowded levels. When volatility is low, option premiums are smaller, and selling protection can look attractive. That can feel like a vote of confidence. But it also means hedging is embedded everywhere, and hedging has a direction. Dealers hedge by buying or selling the underlying as price moves. When price moves within a normal band, that hedging can dampen volatility. When price approaches a level where many options sit near the money, the hedging can turn from a stabilizer into an accelerator. Here's the simplest way to picture it. If dealers are positioned so that they need to buy when price falls and sell when price rises, they act like shock absorbers. If dealers are positioned so that they need to sell when price falls and buy when price rises, they act like a feedback loop. The market can switch from one state to the other around a level, not because of emotion, but because the math of hedging changes sign. Think of it like a highway. At normal traffic, adding a few cars doesn't change flow. But when the road is near capacity, one small disruption turns smooth movement into a jam. In markets, the capacity is liquidity, and the disruption is a break of a level that forces many participants to act at once. That's why the one level matters more than the narrative. It's the point at which the system changes behavior. So let's name the level more precisely and connect it to the dislocation you can see right now. 95. That is not a mystical number. It's a recent low that a huge amount of analysis anchors to because it represents the point where the market last found enough buyers to stop falling. When a market revisits a recent low, it's a referendum. Either demand shows up again, proving buyers still defend that area, or demand fails, revealing the prior bounce was temporary. And here's what makes it dangerous when volatility is still calm. If volatility is priced low, many portfolios are positioned as if the world will remain orderly. Volatility targeting strategies increase exposure when volatility is low. Risk models permit more leverage when volatility is low. The cost of hedging feels smaller, and that can encourage the idea that hedging is optional. The ecosystem becomes more brittle, not because people are reckless, but because the math says risk looks cheap. Then price starts moving violently anyway, like it did around January 29th, and you get the dislocation. Behavior looks stressed, pricing looks calm. Two different markets are effectively arguing with each other. 0-1, even after a messy session. 88, implying the next 30 days should look relatively ordinary. 2% bullish sentiment. That combination is rare at turning points because it means confidence is high while the tape is unstable. 95, the market doesn't drift into the next regime. It snaps often. This is the part no one is discussing enough because it requires holding two truths at once. First, markets can look fine on the close while being unstable intraday. Second, intraday instability is often the precursor to a regime shift, not just noise. A stable market doesn't whip around and then calmly settle. A stable market trends, pauses, and rotates. When you see sudden reversals and air pockets, you're seeing the market test liquidity. You're seeing the auction process struggle to find the right price. And when the auction struggles near a key level, you have to ask who is providing bids and why. That question leads back to institutions, because big players do not announce their intentions in press releases. They show you in timing and in constraints. If a pension rebalances, it does so on a schedule. If a volatility control fund reduces exposure, it does so based on a formula. If a macro desk decides risk has shifted, it acts before the public story is written, because the public story arrives after the price. And if a clearinghouse adjusts risk parameters in a volatile tape, it can change behavior immediately by making leverage more expensive, which can force selling regardless of beliefs. This is why information asymmetry matters. Institutions see flow, depth, and positioning indicators that many don't, but you don't need secret data to understand the core setup. You only need to watch the one level that forces mechanical players to change posture. If the S&P 500 stays above the late January band and buyers repeatedly defend it, the system remains in mean reversion mode. Dips get bought. Volatility stays contained. The narrative of resilience continues. 95 reference, and cannot reclaim it. The system begins to shift. Trend models turn cautious. Volatility control reduces exposure. Dealer hedging flows can flip. And because many managers have limited cash, any attempt to stabilize can require selling elsewhere, which can spread weakness across sectors. This is why the dip can become a trap, not because of doom, because of mechanics. Now let's make the mechanism simple without dumbing it down. Imagine a crowded theater. Everyone is seated, calm, watching the show. The exits exist, but no one is thinking about them. Now imagine a small sign flickers and a rumor moves through the room. Most people stay calm, but few stand up. The movement is manageable. But if a critical threshold is crossed, if enough people stand at once, the aisles clog. At that point, even calm people begin moving, not because they're panicking, but because the system's capacity has changed. Markets work similarly. In calm conditions, liquidity providers can absorb selling. In stressed conditions, liquidity providers step back. The system's capacity to absorb orders shrinks exactly when more orders arrive. A break of a key level is like the point where the aisles clog. It's the moment when everyone realizes the exit is narrower than they assumed. How does the break translate into real flows? Through rules. Some funds have mandates that require reducing risk when drawdowns exceed a threshold. Some strategies reduce exposure when trend breaks. Some desks face internal risk limits that trigger de-risking when volatility rises. Some investors face margin requirements that force liquidation when collateral values fall. None of that requires fear. It requires compliance. And compliance is fast. It happens in batches. It happens at the same time across similar strategies. That's why moves can accelerate. The market doesn't need new bad news. It only needs the system to realize that the old volatility regime no longer matches reality. 88. On January 29th, 2026 is so central to the story. That number suggests routine. The price action that day suggested stress. If stress continues, implied volatility typically rises because option sellers demand more premium to take the other side. If implied volatility rises, leverage becomes more expensive. If leverage becomes more expensive, risk gets reduced. That's the chain. Now, forward analysis is not about predicting a price. It's about understanding what the pattern has historically led to when the setup looks like this. Scenario 1 is the conservative path. The market holds the late January support band, buyers defend the area repeatedly, and the volatility mismatch resolves through time rather than through price. In that case, the index can chop, rotate, and rebuild a base. Volatility stays contained and the dip narrative survives. Scenario 2 is the moderate path. The market briefly breaks below the band, triggers mechanical selling, then recovers quickly, reclaiming the level and trapping the sellers instead. That kind of move often creates a sharp but short-lived spike in volatility and a fast rebound, because once the level is reclaimed, hedges and defensive positioning can unwind. Scenario 3 is the aggressive path. The market breaks below the band, fails to reclaim it, and volatility reprices upward. In that environment, the move down is not smooth. It is marked by sharp rebounds that fail, because liquidity is thin and hedging flows are active. The market doesn't need a new crisis headline to do that. It only needs mechanical flows to shift at the wrong time, with cash levels already low. So what do you watch to understand which path is unfolding? Not 1,000 indicators. A few. 95 reference. Does the market bounce cleanly and hold, or does it slice through and struggle to regain footing? Second, watch volatility relative to price. Does the VIX remain muted even as price swings grow, or does it start rising in a way that signals the options market is catching up? Third, watch leadership. When megacaps move violently, like the roughly 10% drop reported in Microsoft on January 29th, it can be a signal that liquidity is rotating, not just that one company had a bad day. Leadership instability often precedes broader instability because leadership is where passive flows concentrate. Fourth, watch how narratives change around a pause. 75%, the market can stop reacting to rates themselves and start reacting to what rates imply about growth and earnings. That's when surprises land harder. None of this is about fear, it's about attention. And that brings us to the real divide in markets, the one that separates outcomes over time. The divide isn't between bulls and bears. The divide is between people who anchor to narratives and people who anchor to structure. Narratives are comfortable. They give the brain a story. Structure is uncomfortable because it forces you to accept that the market can change behavior abruptly when a level breaks. Most participants learn this the hard way. They experience a period where buying dips works. They internalize it as a law. Then the cycle changes, and they keep applying the old law to the new regime. That's where traps are born. Institutions don't avoid traps because they're smarter. They avoid traps because they operate with rules, levels, and risk limits. They move first because they must. Retail often moves last because it can until it can't. This is why information gaps become wealth gaps over time. Not because one group is morally superior, because one group is operating with structure and the other is operating with slogans. The market right now is offering a simple test. It's asking whether the late January support band is real demand or temporary relief. 88 can remain credible if price keeps acting unstable. 3% has enough shock absorption if the floor cracks. 2% bullish reading can stay firm if the market forces a quick reset. If you understand that, you're no longer watching the market like a spectator. You're watching it like a system. And systems don't care what the crowd believes. Systems care what happens at thresholds. The next time you hear, buy the dip, hear the missing clause. Buy the dip, as long as the level holds. Because once the level fails, it's no longer a dip, it's a transition. This is channel name, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether the market will move. Well, the question is whether you'll recognize the one level that decides if the next move is a recovery or a trap.